Good morning. This is financial and estate literacy. This is It's Your Money. We're going to be talking today about the investment world. It's obviously been an interesting morning getting us here, but we welcome you very much for being here. And I will be monitoring the Q&A part. And so if you have questions or anything else, let us know and I will respond to those. And Pete, do you want to go anywhere or do anything with this? Or
Michael, why don't you show your wonderful faces and come online? There you go. Good morning, Paul. Good morning, Michael.
Good morning.
Yeah, good to see
guys.
you guys. I'm anxious to get the program started, so I'm going to their Ask First form is on our website, IYME. So Paul and Michael have been presenters in the past. They've done an absolutely wonderful job. You're going to love the presentation today. One of the things is that I'm going to give you a brief introduction. Both of them are certified financial planners. Both of them work for the same firm. Both of them understand the dark side, and they can explain what the dark side is. They're now on the light side or the right side. And at the firm, let's get right into how do you charge clients? And I know you give a free a portfolio review to anyone who gives you a call and says, "Hey, I like your opinion, what you think of mine." So, but how do you charge your clients?
Yeah, so we are fee only, no commissions, no product sales, nothing like that. The only way we make money is growing your portfolio. So it's based on assets under management and a percentage on that. Typically, the average it kind of ranges between 0.65 to 1%. And so as your portfolio grows, that's how we make our money, and it's in our best interest to work with you to grow that. So,
and do you have a minimum?
We have really no minimums. No, $5,000. So we've got a retirement side of our business where we help plan participants, children of clients. So really no minimum.
And where are you located?
We are in Irvine, California, and then we have an office in sunny and hot Phoenix, Arizona, where I just was, and Paul is right now. So
nice and cool right now, you mean? From our recent highs, nice and cool here in Phoenix.
But you guys have clients all over the United States, you know?
We do.
Yeah.
We have clients really all over, especially it seems we've got quite a few in Florida, Texas, Nevada, Arizona, Washington, but yeah, all over, even Germany, England, and Kuwait as well.
Amazing with Zoom. It actually makes it feasible. So
yeah.
Anyway, they are basically totally competent in all areas of financial planning, but I've asked them to focus in just on the investment world today. So Michael, Paul, why don't you get going?
All right.
All righty. So kind of just highlighting what we just talked about fee only. We are fee only registered investment advisors. So I think the important things you want to look at when you're looking at an advisor is, one, are they fee only? How do they make money? And then are they a fiduciary?
Yeah.
Do they always put your best interest first?
Michael, I don't even call people who are on the FINRA side financial advisors. I just now call them just brokers.
You do. Unfortunately, the water gets muddied by those brokers calling themselves financial advisors.
Is there a rule? You can call yourself anything, can't you?
It seems
you
like
can
it,
call
yeah.
yourself anything. I've seen people call themselves financial planners without the CFP designation.
Yeah.
I've seen CPAs calling themselves financial advisors.
That's the investment world today. You can call yourself anything you want. There's no law against it. But for our purposes, if you're not a fiduciary and you're not a fee only, you're a broker. You might as well be working for Mercedes and selling cars.
Yeah, and the biggest thing with the broker is, well, a newer thing, they have to act in your best interest, like a fiduciary. it's only at the point of the transaction. So it's definitely more of a transactional relationship, and typically they're not fee only. There's actually only 20% of SEC registered advisors are fee only. So it seems like such a small percentage for just,
I'm surprised
what to us seems like the right way to do business.
Yeah. All right.
All righty. So jumping to just, I think, other things to look for in a financial advisor is, we talked about fiduciary and fee only, but the education, Paul mentioned a CFP, or a certified financial planner. That's someone who specializes in financial planning. Paul and I both have our CFPs. Paul's smarter than I am. He also has a CPWA, which is a private wealth advisor. Then there's CPAs, someone who specializes in accounting and taxes. We have a couple CPAs on our team, and also chartered financial analysts, which is specializes in investments. And we also have CFPs or CFAs on our team. So I think looking for the proper education is key. Experience, making sure assets are at a third-party custodian like Schwab or Fidelity or some other third-party custodian. And then the most important thing, I mean, if they checked all those boxes, just can they meet your individual needs, and do you like working with that person? At the bottom here, we have one, review their Form ADV, which is their disclosure brochure. You'll find a lot about that, if they have any past history with the SEC, so on, how they run their business, and then use broker check, and use that link there.
Yeah.
Can you explain broker check?
Yeah, so anyone who's registered with FINRA or the SEC can be found on broker check. Myself, Paul included. You just type in our name and all of our history of where we've been at, what firms, our experience, any marks on our history would also be on there.
Okay.
Marks would be like disciplinary things for fraudulent sales practices, if the advisor filed bankruptcy themselves, all that sort of things allow you to see on broker check. So broker check is the client's way, or the prospect's way, of kind of looking under the hood, or looking behind the veil, if you will, to kind of get a better idea as to the firm. And you can do it both at the client level at the advisor level and at the firm level. So
yeah, thanks for clarifying that.
Maybe there's an advisor that you're looking to work with. Maybe they're squeaky clean, but if the firm they're working at has 5, fraudulent, claims in the last 5 years, maybe not the best fit.
Yeah, it's FINRA is a self-regulatory organization, and they have established a database of everyone who should be in the financial services industry has to be registered with FINRA. And that's why it's so important that you look up the individual that you're dealing with, and to find out just basically, are they a broker or are they a financial advisor? So if you look up, you Google broker check, the FINRA website will come on. If they are a broker, you stay on FINRA. If they are a financial advisor, or what they call a registered investment advisor, then you go to what's called the SEC, Securities and Exchange website. So and then it tells you also whether or not they have disclosures. And so what is a disclosure, guys?
Yeah, those are. Go ahead, Paul.
It's just a mark on your license. A disclosure is something that was done that shouldn't have been done. So could have been an unscrupulous sales practice, could have been fraud, could have been the advisor themselves filing for bankruptcy. But typically you want 0 disclosures. If there's a disclosure, that means there's something that went wrong at some point.
Yeah. So companies like LPL, Wells Fargo Advisors, UBS, Morgan Stanley, Merrill Lynch, they have hundreds of pages of disclosures, and they're still in business. It just amazes me. Yeah. But you want to see how they've been, and they get slapped on the wrist, and they have to pay a penalty, but there's always a little phrase at the end that says we'll pay the penalty, but we're not admitting that we've done anything wrong. And so please use this database to look up your advisor.
Real quick, just touching on the regulatory bodies that we've kind of talked about. FINRA is the Financial Industry Regulatory Authority. It's a self-regulatory organization. So it's kind of self-policing. Advisors that are a member of the New York Stock Exchange, anyone that's involved with that has to be involved with FINRA. So like I said, it's kind of like self-policing. The government arm that oversees the industry is the SEC, the Security and Exchange Commission. They're the ones that set the rules. They're the ones with the final say in our industry.
And those are the ones that audit us, make sure we're doing business as we say, and staying on the up and up.
Approximately how many clients do you have and how much do you have under management?
Yeah, we've on our wealth management division approximately 1.1 billion in assets under management. And that's roughly I think around 1,000 clients.
And what's the ratio of clients to staff?
We all work as a team environment here at BFSG, but it's typically what, Paul, like 50 to 60 clients.
Yeah, I would say at max 75.
Yeah.
The typical broker has anywhere from 1,000 to 3,000 clients.
Yeah, I mean, the one reason we work as a team, I mean, is there's one from an education standpoint. I mean, there's Paul's his skill set is different from mine, and we complement each other and other people on our team as well. And there's just a lot of planning that goes on throughout the year. It's not just a one-time thing. So
yeah, especially if you're not just selling product. So
yeah,
let's go to
All right. So you'll hear advisors talk about different licenses.
Yes.
The most common ones are going to be the 7, which allows them to sell all securities, stocks, bonds, mutual funds, all that good stuff. And then what's called the 66 or the 63 and the 65. The 66 is just the 63 and 65 combined into one license. And then if it's a supervisor, they're going to typically have either the 53 or the 24. But these are the licenses that are required in order to sell product. So when you see the 7, that typically is a good signal that they're a broker working at a broker dealer selling product.
And neither you or Michael have a Series 7.
I had it at one point. I don't have it anymore.
That's when Paul used to work on the dark side.
The dark side.
So let's clarify what the dark side is. I started my industry with Wells Fargo. Later moved to JP Morgan. And great companies. Good place to cut my teeth. Learned a lot there. But the challenge is they sell product. Good example is I actually left JP Morgan in 2013. The reason I left is I got called out on a sales call with all other advisors for not selling enough annuities. And I wasn't product driven. I was trying to do what was best for the client, be a true fiduciary. They didn't necessarily like that because it didn't make them the most money. So getting called out on a call where I was doing well relative to my peers, but getting called out on that was just the last straw for me.
And
so
we'll
I
see.
saw the light,
Yeah.
and we moved to the light side.
And we'll see later on when we get to annuities in this presentation why they push individuals to sell those, because they have large commissions.
Well, and the other thing too is Paul, I mean, your when you received a paycheck, it wasn't from the client, right?
No, it was a commission. Everything I did was commission based.
Yeah. So you were beholden kind of to Morgan Stanley because that's where your check came from.
JP Morgan. Yeah. Correct. All right, so let's do a quick dive in here on just insurance. Term insurance is by far the most common insurance, and for 98% of all individuals, this is all you need. Term is a life insurance coverage for a specific period in time. It could be up to 30 years. Most commonly we see about 20 years. So a good example of this is a young couple have their first baby. They're going to go out and get a 20-year life insurance policy to cover their new baby until it's in college. Something like that would be a good example where a term is used. The idea with life insurance in general is when you're young and building your asset base, you probably need more insurance. But as you get older, kids move out, houses get paid down, salaries become larger, you grow your assets. So your need for life insurance decreases over time. And so that's why term is such a good solution for most people, because it gives you a lot of coverage for a little money, and it's going to meet your needs over the time period and adjust over time. Permanent life insurance or policies are designed to last the rest of their life. These are typically sold, they're not typically bought. Typically, it's an agent pushing this. They're going to sell it as an investment vehicle. They're going to sell it as long-term care when it's really neither of those things. And we'll dive into that a little bit later. But how you can tell the difference between a term and a permanent policy is the permanent policy has a cash value attached to it. Now, they will use this cash value as a way to sell the policy, but in reality, that's bad practice. All that cash value is designed is to pay for your future premiums, all right? As we know, the older you get, the more expensive life insurance becomes. So the idea with this cash value is in your younger years, let's say here's your cost of insurance. Here in your younger years, you're paying more than what the cost of insurance is, building that cash value. Then that cash value is being invested to meet future premium needs. Because at some point, the cost of insurance is going to be more than you're paying. So that cash value is designed to grow to help pay for the premiums in the future when it's more than what you're paying on your annual premium.
What is
Hopefully
the
that made sense.
average commission on these products?
Oh gosh, 8 to 12%.
And I mean, personally, there's a need for like just me to, if something were to happen to me, take care of my family, pay off the mortgage. I have term insurance. It's the cheap, inexpensive way to go. The whole life policies and permanent insurance, there's a time and a place for those, but I think of everything on like a probability kind of curve. And it's only on those tails of the probability curve when you probably need those. Most of the time, if you need insurance and there's a need, term's going to be the way to go.
Yeah, now there are times for permanent insurance if we're dealing with estate issues. Maybe you want to leave money, a specific amount of money to a charity. A permanent life insurance policy can be a great way to do that. Or more common where I see this is maybe there's an amount that needs to be left behind for a special needs child. Then having a permanent insurance in place to help protect their coverage is one of the best ways to do that. So these can be excellent policies for the right people in the right situations, but they're typically something we back into, not something you lead with.
Yeah. And unfortunately, they get led with too much.
Yeah.
So let's pivot to just another form of insurance is annuities. And we're going to talk about some different deferred annuities, fixed annuities. It's just like it sounds, you get a fixed guaranteed amount. And then that money grows. Historically, until recently, the fixed amount was very little. With interest rates moving up, they've moved up some. They haven't kept up with interest rates though. But you can kind of lock in. I don't know what today, Paul. Are you seeing anything higher than, around 4% or so? Fixed contract?
3.5 is kind of the top that I've heard.
Yeah. So, but then there's costs, and we'll get into costs later on. But it sounds just like it is a fixed amount. You're getting a fixed return on that.
Annuity means what?
An annuity means you're getting a stream of income.
Yeah.
Paycheck for life.
Yeah.
Think of it as a self-pension. Life insurance is designed to protect against early death. Annuities are designed to protect against you living too long and provide an income stream for the rest of your life. That's how annuities were originally designed.
Yeah, like a longevity insurance in a sense.
They've been around for 200 plus years.
Yep.
They have.
Yeah,
the original annuities were what are called immediate annuities. you give the insurance company a lump sum of money, they turn that into a paycheck for the rest of your life or the rest of you and your spouse's life.
And again, you know, I would say 90% of individuals don't need an annuity, but they're often sold based on fear. So, hey, the world's going to hell in a handbasket, and this is the security of having a steady income.
Yeah, for example, that fixed annuity, I mean, kind of going, hey, your markets are volatile and they prey on that fear. Why don't you lock in a 3.5% rate today? But inflation has hovered between 2 to 3% over the last 50 years, closer to 3%. And then after the fees, I mean, you're not earning a real return. So
I wish most people, this is not a good product for you, but I hesitate sometimes to call a product bad, because in some circumstances, this may work for someone. And that's why, again, the fee only best interest standard is so important, is to figure that out for the client as to what fits based on their particular need. What is a variable annuity?
Yeah, so variable annuities are really, you take that money, it's in an annuity, but you get to invest that money. So you still have the investment risk and the potential to make or lose money. Unfortunately, variable annuities have some of the highest commissions. And then two, the underlying products, investments in there typically have high fees as well. Typically a product we saw a lot of. Nowadays, you're seeing a lot more indexed annuities, the third one there.
The free lunch and the free dinners come in.
That's where the free dinners come in. Yeah. So they take you to fancy steak dinner and they pitch you something because they're making a commission of 7 to 10% typically. And with an index annuity, is your return is linked to some index, typically like a stock market index like the S&P 500, and they get sold as, hey, you get upside with none of the downside. And that sounds amazing. And then they all also unfortunately sell, and I just had a client come to me the other day saying, no, there's no fees, which is a bunch of BS.
Yeah, in annuities, that line gets used a lot by insurance agents, because they say, you're not paying me, the insurance company is. And hey, these products are loaded with fees.
They're built into it. And so on an indexed annuity, you typically get capped on the upside, like 10% or something like that.
The caps are typically 4 to 6%.
Yeah, 4 to 6%. Yeah, and then you get no downside typically. But over the past 200 years, around 47% of stock market returns have been above 10% in a given year. And then also these index annuity products, they have a bunch of ways. I mean, it's like reading it's impossible to read these documents, but they don't include dividends. And dividends have historically accounted for 32% of the return of the stock market. So there's a lot of ways they make money, and it's at typically the holder's detriment.
Yeah.
Annuities like they said, you're capped at 5 or 6%. Let's say that you're capped at 4% and the S&P does 10%. They keep that 6%. That's how they get paid.
Yeah. And they know his history and what the probability are of things. So it's like, oh yeah, with returns almost 50% of the time being above 10%, and we get to collect all that premium. Yeah. Again, I mean, the time and the place for these products, if you're just putting your money, you're too afraid to invest and you want some type of guarantee, it's better than sticking it under a mattress a lot of times. So there's a time and a place for these, but unfortunately, like you said, Pete, they prey on fear, especially during times of volatility.
Or lack of knowledge.
Or lack of knowledge, yeah.
Because annuities are sold rampantly to school teachers across the country. And it's really sad. In fact, the New York Times did a special series on variable annuities and indexed annuities to school teachers, saying that basically you needed a PhD in math to figure out what your return rate is. Anyway,
especially those index annuities.
Yeah, we'll go through an
So
example in a second here.
yeah,
yeah, so let's jump to just the fees real quick. This is an example of a variable annuity. Is one, I mean, we've seen as Paul kind of previously mentioned, as high as 15% commissions on some of these products. But the other thing is they're illiquid to a certain extent. We've seen surrender charges up to 15 years. And so you can see on this, like the first year, if you want to get out in that first year, you're going to not just pay that incoming commission, but you're going to pay an 8% penalty to get out of it as well. And then that drops down every year you're in the product. Again, we've seen these go out all the way out to 15 years. They get sold, unfortunately, to seniors a lot of times when they need liquidity the most because of maybe some
well,
medical event comes into. Go ahead, Pete.
it's fear driven.
Yeah.
We'll take care of you. Let's go to the next slide.
Yep.
So when we look at the annuity fees, they're expensive. We've made that perfectly clear at this point. The type of fees that you're going to pay is first going to be what's called mortality and expense. This is the actual cost for the insurance wrapper that you're essentially buying with the annuities. There's typically an administration charge of 0.25%. This is for mailing you your statements, all that sort of thing. Now, with a variable annuity, the money is actually invested in mutual funds and ETFs, and we'll talk more about what those are in the future. So you're getting exposure to the stock market or the bond market. There's a fee for those investments. That fee is typically 1%. And then oftentimes they're going to sell you what's called a living benefit rider. So they're going to give you guarantees on income streams in retirement. Those guarantees are not free. You're paying for them. And that's going to be typically another 1%. So all in on these annuities, what I typically see is a fee of around 3.5% to 4% per year is what I see on average for a variable annuity.
Yeah, and that's outside of the upfront commission that they got on top of that. That's an ongoing annual cost typically.
Yeah, and in addition, do annuities spit out capital gains kind of income, or is it ordinary?
When the money's taken out, any gains are taxed at ordinary income tax rates instead of capital gains tax rates. So upon distribution, the earnings are not tax preferential.
No.
Yeah.
So
typically capital gains are at a 15% tax rate or lower, depending on your tax bracket.
Tax efficient.
Very tax inefficient. Yeah.
I love this slide, and Paul, you did a great job of explaining it.
Yeah.
You should be at every free dinner because
so this is an actual client that I worked with back during COVID. Okay. This was sold to them by another advisor. Okay. So this is an example of the client's return in 2020. Okay. So they are working with the S&P 500. Now there's no annual cap. Like we said before, typically the cap is 4 to 6%. That's an annual cap, the most you can make in a year. This one doesn't have that. Instead, they just have a monthly cap of 1%. So if the S&P goes up 2% one month, they make 1% instead of 2%. That's how this works, or how it was sold. How it actually works is they cap you on the upside. So in the first month of the year, the market was up 3.2. They got capped at 1%. We understand that monthly cap 1%. What they don't tell you is they don't cap you on the downside. You're only capped on the upside. Nice of them, right? So month 2, you're down 1.3%. Now your return is negative 1.3. We go through, we had these 2 big drops, right? The first 2 months of COVID when we had those lockdowns, 2 big drops in the markets, 10% each month. That locked in a negative 20% return for them for the year. That's a hole that they couldn't get out of. So at the end of the contract year, their return based on how it's calculated with the insurance company, negative 16%. Negative 16%. The actual return on the S&P 500, the index that they're supposed to be tracking, 15.76. That is that's 30% difference from what they're supposed to be tracking. So their return was 0% because they're not going to have any losses in indexed annuity. So this is why we are not a fan of indexed annuities typically, because stuff like this, just too many shenanigans.
Yeah. You got to read the fine print.
Yep.
Don't give you a free dinner and free wine for nothing.
Yeah. Yeah. So let's kind of transition. We've talked about insurance now with the life insurance and the annuities. We're going to transition now to investments. Okay. And just remember, annuities or insurance, not investments. With investments, we're looking at things like traditionally stocks and bonds, right? Stock is literally just ownership in a company. You're going to make money when they do well, you lose money when you do bad. With a bond, you're simply doing a loan. Okay, so think of a mortgage you have with a bank. With a bond, you are the bank. So instead of you paying principal and interest like on your mortgage, instead with a bond, you're the bank and you're loaning your money out to Apple for a new iPhone, the city of LA to rebuild freeways, a new school being built, whatever the case is. So you're loaning your money out, and instead you're getting that payment over a period of time. Now, for a long time now, what we've seen are what are called mutual funds. And all a mutual fund is they're pooling your money together with other investors. Let's say you have 100,000 to invest. If you were to go out and buy your own, pool of stocks, you're realistically going to probably buy 15 to 30 stocks. That's pretty decent. But with a mutual fund, what they do is you give your money to the mutual fund. They're going to pool your 100,000 with other investors that have 100,000, 500,000, a million. So now they have typically hundreds of millions or billions of dollars to go invest as a group. So then the fund manager, the person running the mutual fund, is going to pick the investments on your behalf. And they're going to be tracking to a specific investment strategy. Maybe it's the S&P 500. So they're going to go invest your money in the 500 largest companies. So with a mutual fund, it allows you to have greater diversification. Instead of having like 13 companies at 100,000, now you're going to have 500 or thousands of different companies in your portfolio. And then the investments generate returns. There's a small fee, like we said before, typically around 1%, as we talked about in the variable annuities. And then the remaining amount goes to the investors. So if the mutual fund does 10% and so 1% fee, you're going to get a net return of 9% as the investor.
On most investments that you can, or monies that you can put in vehicles, are done on the New York Stock Exchange, the NASDAQ, and I believe that you can invest in real estate on the NASDAQ and New York Stock Exchange. You can invest in public partnerships, etc. Why is it important to go through the New York Stock Exchange or the NASDAQ, a public exchange, versus doing it on a private level?
Because those public companies are audited. Not to say there's not fraud that happens still, but they have to follow certain regulations to stay listed as a public company. They have to go through formal auditing and have a public accounting firm audit them. So there's more safety, whereas a private company doesn't have some of those regulations and so on. So
liquidity, I was thinking of as well.
Liquidity is a huge piece too. Public market, you can trade and sell on a daily basis. I mean, up to by the minute if you want to, with certain exchange traded funds or individual stocks. Mutual funds trade at the end of the day, but private, companies, it's private, and typically you have zero liquidity until the exit through an IPO or being bought out or some other way.
I mean, we've had clients that have had a private investment that was supposed to last 7 years and they end up lasting 10 or 15 years, for example. 15's
easy.
So before you make an investment, you should ask, how do I exit from this investment?
Yeah, and match it to your time horizon. That's the key, is knowing what your time horizon is and how is the portfolio being structured to meet your needs over your time horizon.
Approximately how many mutual funds are there in the country?
I
30,000, 40,000, I
I
think.
was gonna say more than 10,000. I have no
Yeah,
idea.
I think it's 20 to 30,000.
Yeah,
Yeah.
it's a lot.
Yeah.
And exchange traded funds too are really just a mutual fund. It's a same type of pooling your money together, but they trade more like a stock throughout the day.
Right.
And they're a little more tax efficient vehicle. And I think Pete, probably in the series, you guys have more on getting into the mechanics of those.
Yeah, but there's basically two types, and this is this slide that we talk about it. One is called load, and the other one is called no load. Talk a little bit
Correct.
about that.
Yeah. So again, talking about working with a broker versus a fiduciary. A broker is going to sell you a mutual fund with a load. Okay. That's going to be their commissions. That's how they're paid. Okay. So with mutual funds with loads, these are sold by your brokers. And they're going to be coming in one of two flavors. Either it's called Class A or Class C. Okay. Class A is designed for someone that's investing long term. So here on the Class A, you pay 5.75% on average up front. So if you invest $100,000, you're going to have your commission that goes to your advisor of $5,750. So you're only investing in the mutual fund $94,250. So you're already behind the 8 ball because of that 5.75% commission.
This is kind of how real estate works as well. You know, if you buy a real estate and you pay a commission, your agent gets, let's say it's 6% when you sell. Well, the agent that sells you the home doesn't keep the 3%. They split that with Coldwell Banker or First Team, etc. How does that commission work in the investment world? Let's say if you were with JP Morgan.
So if you're with JP Morgan, that 5.75 is going to go to it goes to the company. So this 5.75 is what goes to JP Morgan. Each broker has their own different commission structure, anywhere from 20% to 50 or 60% typically in the broker world. And they're going to get, say, half of this fee, theoretically.
The other thing too, which we don't have on here, is there's something called 12B1 fees, which typically are about a 0.25 to 0.5%. Those are called marketing fees that go to JP Morgan to market that for marketing that fund. So
yeah,
there's that other
not
kind
all
of
funds have the 12B1, so that's
yeah,
just
not
an
all of them
additional
do.
thing to
Yeah,
look for.
yeah.
Now the other thing too is with this mutual fund, you're paying this 5.75, but then on top of it, you're still paying that annual expense ratio for the mutual fund itself. On type A shares, you tend to be paying about 0.5% per year on average.
Yeah.
And that's on top of, that's 0.5% is ongoing. This 5.75 is one time when you make the initial investment.
Yeah. I always,
Um,
you know, that you
Good.
end up in the hole before you even get out of the gate. You know, most people
yeah,
realize that. And the thing of it is that one of the things that you can control in the investment world is your expenses. I mean, that's a huge hit right up front.
And one of the
yeah,
problems we see a lot too is, I mean, as Paul kind of mentioned, and if you are in a Class A, it's supposed to be held for a long time because you're paying that 5.75 that you have to recoup over time. But we'll see where they bought a Class A fund, and then 2 years later, the broker's going, "Oh, let's get out of this fund and buy another fund," and that's just because they're making another 5.75 again. So you see turnover, unfortunately, too, because the broker's getting paid to have activity in the account.
If you're with
yeah.
your broker, look at your statement. And if you bought a mutual fund through your broker, you'll have a class, an alphabet after that mutual fund. Make sure you understand what that class means, and you can Google, say, JP Morgan Fund or American Funds, Class A or Class B, Class D. And that way you understand what you're paying much more clearly than just seeing a class alphabet letter after the name.
Yeah, and that's important to know. I mean, all the funds are the same. So like you can get like an American fund New World A, American Fund New World B, American Fund New World C. The underlying investments, the manager, it's all the same. It's just the fees are different on those and how they're
Right. It's just
how the
how the
broker got
fees are
paid.
being paid.
Yeah.
Yeah. So Class A was originally designed for someone holding a fund 5 years or more. Class C was designed for someone holding it 5 years or less. So with the Class C, there's no upfront sales commission. Okay. You pay 0% upfront. If you invest 100,000, all 100,000 is being invested day one. Where they get you with this is instead of that annual fee being around 1% per year for the mutual fund, it's 2% instead for a Class C. So if you do the math, typically after about 5 years, you pay more in fees in Class C than you do in Class A. With the Class C, unfortunately, like I said, they're designed for more short-term needs. A lot of brokers these days are selling them. They're not selling Class A's anymore because that people have caught on to that upfront sales charge. So instead, they're just doing a lot of Class C's, and they're just collecting that back end fee instead because it's an easier sell.
Yeah. They're supposed to, by law, after 5 years, transfer it back over, but you know, a lot of them don't do that. So this is one of the reasons why we encourage you to take your present portfolio to a fee-only advisor and let him take a look at it for you so that you can interpret some of these language and get you to understand exactly what you're paying. And all the fee-only advisors are willing to do that because we want you to open your eyes to what's going on in the industry. Let's go to the next slide.
Yeah. Real quick, when you're looking for mutual funds, you should ideally be looking with no loads, just no upfront sales commissions.
All right. So just getting to the hot, I don't know if it's hot anymore, just with the price of Bitcoin and other cryptocurrencies, but we just, again, anything that there's always new products coming out from Wall Street, and just be wary of the new hot thing.
And
everyone may have their own view of cryptocurrencies, but they're still, to trade them, very expensive. So all those kind of fees we've been talking through, life insurance, annuities, mutual funds with loads, buying Bitcoin and other cryptos, it's still expensive proposition, and just the volatility, as you can see on the left-hand side of the chart, is just off the charts compared to stocks and other types of investments.
the mortgage crisis was brought on by the new hot investments that these mortgages were combined into a supposedly secure bond, and the underlying mortgages were, not very stable. And, so it's, there's always going to be a new kind of a product. And I know your last slide talks a little bit about that, but are you seeing people who have bought Bitcoin, or are they still buying it, or do you think that has ended?
Well, I don't think it's ended, but the momentum's definitely slowed down. And maybe the technology behind these cryptocurrencies has some use case, but just as far as an investment, it's very speculative. And so I think with interest rates going up, the cost of capital going up, and people, you've seen a slowdown in the interest, and the price too. I mean, has fallen back down on cryptocurrencies and Bitcoin specifically.
I still see commercials on the air about, you got to buy gold today. The volatility, people are going to war. We're going to go back to a gold standard. Is gold a good investment?
Over a long period of time, historically, no. It has no cash flow. It pays nothing. It's worth what someone else is willing to trade you for it. So as you kind of mentioned, Pete, it's good in times of fear. And gold may be kind of again, on that probability curve, in times of extreme inflation or times of deflation, gold may hold up, but 95% of the time we're not in those scenarios, and gold's a poor investment.
So that maybe lead us to the question that was literally just asked. Can you explain digital in banking? And the second part of it is, and the safety in buying gold, which you probably just answered. Digital in banking.
Well, digital, I mean, money today is digital. I mean, not too many people use cash, hard cash anymore. It's credit cards, debit cards, and so on, Venmo, whatever else. So we are digital, using dollars. So that's one of the things. I mean, Bitcoin always gets talked about of being a digital currency. I mean, really, the dollar's been digitized. And gold, you can buy investments in exchange traded funds and other products that invest in either actual gold bars that are stored somewhere or gold miners, or something like that. So you can buy gold, but you can buy physical gold. And again, the commissions are very high to buy physical gold, going to a dealer and buying and selling gold.
Thank you.
So hopefully that answered the question.
Yeah. Commodities, should we be buying pork bellies and
No,
I mean,
again, I think commodities are very volatile, and over a long period of time, not a good buy and hold investment, just like gold and cryptos. And typically the people buying commodities is companies, because they're trying to hedge. If I'm a farmer that raises hogs on my farm, and the price of selling hogs collapse, I can hedge that by buying a commodity. So, or an airline buying fuel. And that's where we see a use case for commodities. Commodities, I mean, do well when inflation is kind of rampant, but buy and hold, they're really volatile and typically not a good investment over a long period of time.
Yeah, the key difference is investing versus trading.
Yeah.
Trading is for short-term games, it's legalized gambling. Investing, there's no guarantee it's going to go up, but history suggests that if you hold investment 5 years or more, you should end up higher than where you started.
What does IG mean?
Investment grade bonds. So you lend money to, in the example Paul used with Apple, helping them build an iPhone factory, and then Apple's paying you back that bond. So and that's less credit worthy. I mean, Apple's a very credit worthy company, but there's more risk because the U.S. government bonds, like treasuries or mortgage bonds, which are guaranteed by the government, there's no risk of default there.
Should people be buying individual bonds just and compare the bond market to the stock market?
Yeah, no, I don't think most people should be buying individual bonds, because the commissions are high on there. Use a mutual fund or exchange traded fund to get exposure to bonds. It's a cheaper way to do it and more diversified, because you can only buy so many bonds, typically at $10,000 to $15,000 per bond.
And bonds
go ahead.
trade like real estate. There's a middleman involved in the process. So bonds is not an exchange. So you have to go out, and middleman has to go find someone to buy what you're trying to sell, or vice versa, at a price you're willing. So there's a lot of negotiations. It's not an easy thing to purchase. There's always a middleman. There's high cost because there's a middleman.
And
stocks trade on an exchange where everything's done automatically and in milliseconds.
And
so
which
very
is
easy there.
And which is more transparent for a consumer, as the stock market,
Stocks.
the bond market?
The stock market.
Stock market.
Okay.
Priced daily by the minute. Bonds sometimes won't trade for months, years, depending on the liquidity of the bond. So prices can be stale as well.
Okay. And what does core CPI mean?
Consumer price index inflation. So
so when you do a financial plan for people, what do you use to project as an inflation number?
We use right now we're using 3% in the financial plan for the life of the plan. That's for the core kind of base plan, but then if there's education needs or medical needs, we layer those in, and those inflation costs have typically ran between 5 to 5.5%.
Cash is amazing. for the past 10 years or plus, maybe 15, I can't remember when we received a decent return on cash. Now all of a sudden we're getting actually, and we're actually can earn some monies in cash. What does cash play in a portfolio? Should people still be putting it underneath their mattress? And how much cash should somebody have? And
Yeah.
talk a little bit about cash and what it plays in a portfolio.
Paul, you want to answer the first part with how much they should have, and then with the role within the portfolio, I'll take care of that.
Yeah. So with cash, you typically, the general rule of thumb is 3 to 6 months worth of living expenses. So if you takes $5,000 to pay your bills each month, including like your mortgage or your rent, then you'd want at minimum 15,000, on the upper side about 30,000 in cash for that. And cash should also include any money you have set aside for a major purchase in the next, let's call it 18 to 24 months. So 2 years or less. So if you're doing a home remodel, using cash to buy a new car, cash to take a big trip to Europe, whatever the case is, you want that money in addition to your emergency fund.
Okay.
Anything beyond that, you can begin to look at investing.
And you want it liquid. So in a savings checking account, or preferably today, a high yield savings account, which is earning around 4 to 4.5% today. So something very liquid for that emergency needs or short-term needs. Cash as a rule within the portfolio is cash over long periods of time does not keep up with inflation. And you lose money on cash. So today, yes, it's earning a little more, but that will likely not be there in 12 to 24 months from now, as interest rates move back down. And so cash is historically not a good long-term investment, because it does not keep up with the rate of inflation.
Who's your custodian? Who do you use as your custodian?
We use Schwab and Fidelity as our two custodians.
I'm with Schwab, and one of the things I love about it is that they have a bank and a brokerage, and so I can use their bank as the kind of pay checks out of and get cash from it, and they'll automatically transfer from the Schwab Value Fund over to the bank account to pay cash. So today, for example, on my money market account, I'm earning 5% on on my checking account. And it's a wonderful way to earn some monies versus having it in a regular bank.
Yeah, money market accounts at Schwab are earning around 5.06 on a government money market fund, safe type of investment. Treasury bills are earning between 5.4 to 5.5. They're kind of like cash equivalents.
Money market safe?
Yes.
For the most part, it's safe. It does not have FDIC insurance.
Yeah.
So it is not guaranteed. Money markets are designed to be valued at $1 per share. Only one time in recent memory that has what they call broke the buck. That was in 2008. And that actually was a scary time for the money market fund. So as long as we avoid those 2008 sort of events, they tend to be generally pretty safe.
And in the money markets, we typically advise clients to purchase our government money market funds that are investing in treasury bonds and so on, treasury bills, short-term paper, not prime money market funds that are going out and buying investment grade corporate or commercial paper and so on that could swing a little more. So you can maybe pick up a little extra yield, but we just don't think it's worth it for those extreme events like a 2008.
What is the safest investment in the world?
Treasury bills.
And what is Treasury bills paying today?
5.4 to 5.6 for anywhere between 3 months to 1 year.
So if that's the safest, do we use that as kind of a barometer if somebody's offering us 15% return?
Yeah, that's what they call the risk-free rate is a 3-month treasury bill. So that's what you want to compare against. If I'm buying something and I'm only getting a 4% return with risk, why should I go buy that when I can go get 5.3% today?
That's how I help clients when we're looking like buying a rental property. That's the what I call the hurdle rate, the minimum rate of return that we need to get for the client to see if the rental property makes sense.
This, speaking of, do you consider a home an investment? And talk a little bit about real estate as an investment.
Paul, if you want to jump to a couple slides down too, I know we have
Yep.
a slide in there, but real estate as an investment, primary homes, we don't think you should look at as an investment. I mean, yes, you may appreciate over time, and homes have historically appreciated around the rate of inflation a little higher here in Southern California. So it hasn't been a bad long-term investment, but it shouldn't be looked at as an investment because one, it's illiquid and it's where you live. Secondary homes, rental properties, and so on can be looked at as investments. But you can either do that and buy a property, or you can buy real estate within something called a REIT, a real estate investment trust. And those, one, they're private investments, or you can buy publicly traded REITs on the public stock exchanges.
Michael, one of the things that I see is that people who own rental properties don't know what their net return is. Do you guys help your clients figure that out? Because if you don't know what your net return is, how can you compare it to a REIT or
I've developed several spreadsheets over the years to help clients with that sort of analysis.
Yeah, you got to do the numbers. And
yeah. And that's a thing. I think people think of real estate like, oh, it's not volatile and it goes up, but it's volatile as we've seen in the past. It's just not marked to market and priced every single day. So you just don't see that volatility, and you need to know what your return is. What's your expenses? What's your income? And knowing what that rate of return is, because it may be a lot less. Like today, Paul and I were just talking about this the other day. Like here in California, on average, we're seeing cap rate or like a return on rental properties here in California between 3 to 4%, which is pretty darn low.
2.8 to 3.8.
Yeah, even lower. Yeah.
And that's not counting the sweat equity.
I just sold a rental property last year, and it's coming as a landlord. It's not a fun business to be in all the time.
And not only that, but it's also, again, it's talk a little bit about when you're investing, the importance of diversification and liquidity. People forget those two issues.
Yeah, it's liquidity. Real estate takes time to sell. I mean, it's been a hot market, so it's been a seller's market. So real estate's turning over faster, but it still takes time to get out of that. And then there's commissions, like we talked about, of up to 6% typically on real estate. So it's not and then if you're not buying a REIT that's a diversified fund that's holding a lot of properties, you're exposed to one market, one type of property. So you can buy publicly traded REITs that are diversified, that have exposure to office properties, multifamily, malls, residential real estate, hospitals, warehouses, so on. So you can get diversified buying a publicly traded REIT, but buying it on your own, it's going to take a lot of capital to do.
Yeah. So go ahead, Paul.
Real estate is a fantastic investment for a lot of individuals. You just want it to be a part of your overall portfolio. You want to have stocks and bonds, so you have liquidity. You want to have some real estate, so you have some tangible assets and some income sources. So it's a great part of someone's overall portfolio. You just need to work with it. Most of the time, it's best to work with a professional to figure out how much is best for you, given your situation and your personality.
Yep.
And I say your personality because not everybody should be a landlord.
Yeah. It takes a lot of work. Right? It's not just, hey, bought a piece of property and now I can get a property manager and everything is going to go smooth. Lots of issues. So REIT stands for Real Estate Investment Trust.
You got it.
Okay. Can you purchase also oil and gas partnerships on the stock exchange?
You can, and those typically, I mean, have higher, a REIT and partnerships like that typically have to pay out 90% of their cash flow to you. So they have higher income or dividends that get back to you, but not as much appreciation potential. But you can buy those as well. Those are more volatile, oil royalties and partnerships and stuff like that.
Each of a person's portfolio is usually in a REIT or in an oil and gas outside of just stocks and bonds.
For oil and gas, we don't typically do those, so very minimal, just because of the volatility and the nature, as we kind of talked about with commodities, not a good long-term investment. Real estate, typically a couple percent.
That
It's not a huge chunk of the portfolio.
okay. Let's go to the next slide.
Well, I think you got this one with the reverse
I do.
mortgage.
Yeah, so reverse mortgages. This is where you can use your home and turn that into a paycheck for the rest of your life. Sounds great in theory. In practice, it can be a dangerous thing. Where reverse mortgage makes sense is for someone that doesn't have other assets. You still want to live in your home and you have a lot of equity built up in the home. Maybe the house is paid off and it's worth $1 million. That's $1 million that you can use to live off of if you need to. And a reverse mortgage allows you to tap into your equity and turn that into a cash flow for you. Now, these reverse mortgages are extremely complex. And in fact, they're so complex that after you've talked with the broker, the person that's selling you the reverse mortgage, you have to have a counseling session with an FHA approved individual, and they are a completely innocent third party. They are completely neutral to the transaction. They have to talk with you and they have to be comfortable that you understand the docs that you are signing and that you are physically, mentally have the mental wherewithal to make that decision.
I'm not
only investment assistance
impressed
that I know that has that.
I don't know about you, Paul, but I have not been very impressed with those third-party reviews. They they kind of say, you're tapping into your equity in
Sure.
your house. Do you understand that? Oh, okay, you understand that. You're approved.
Those are
it's
newer
not
too. I mean, these used to not be required, but unfortunately, I mean, people were selling these things, and so that is a newer requirement. But you're right, Pete. It's like a Band-Aid on the problem of these. It's not.
These have been around for almost 20 years. The first 15 years, it was kind of the Wild West. There's been a lot more scrutiny, a lot more standardization within the industry, I'd say, in the last 5 to 7 years. And so that's been good to see.
Yeah.
Again, like most of the investments we've talked about here, this is not something you lead with. This is something you kind of back into based on different situations.
Absolute last resort type of thing, and then get with somebody like Paul or Michael, somebody who's familiar with these, who is not trying to sell you one of these, to see whether or not it's appropriate for you.
We've helped three or four clients in the last 3 years on looking at these.
Yeah.
So,
Yeah.
And again, I mean, there's a time and a place for every type of product, the life insurance, the annuities, the reverse mortgages, and on your specific needs. But unfortunately, they get sold like they should always be the first
And what
line of defense or whatever it is. So.
And in my business as a private fiduciary, what I see is that many a times the individual who has a reverse mortgage needs to go into a board and care. They can no longer live at home. And one of the problems is that if you go into a board and care and not live in the home, that means the reverse mortgage has to be paid off, has to be, and the only way to do that is to sell that property. And that means is that usually the capital gains tax on that sale is just huge. And you cannot, once you go into a board and care, you cannot rent out the home and use that rental income to pay for the board and care. It's a forced sale. And most individuals do not understand it because they think that they'll never have the possibility of moving into a board and care or an assisted care facility, or buy down into a smaller home. So it's an issue. Anything else did you want to say on, Paul, on the reverse mortgages?
No, just be extremely cautious. Strongly talk with someone that has experience with these, like a financial advisor. And not all financial advisors have experience with these, so something you really need to check on. But get that independent third party to help evaluate the situation.
I think the commission rate is somewhere around $8,000, no matter the size of the reverse mortgage. So there's a lot of money into the person who's trying to sell it to you.
Yep.
You have a slide called kind of the overview of the market as to what, let's see, yeah, that one.
This one. Yeah.
I missed this one.
We skipped it, but kind of what we were talking about, just there's always some hot tip that you hear from some neighbor or someone else that, hey, I'm making a fortune, and until they're not, and you get in at the wrong time. And it's been the history of time. There's always some hot Wall Street product, from way back in the day. Tulips were the hot product, to railways, to you name it. I mean, during the Roaring '20s, railroad stocks and other investments, the tech bubble during the dot-com of the 90s and early 2000s, and that popping of the bubble, real estate in 2008, and now the FOMO, or fear of missing out stocks, the GameStops, the cryptos, all those kind of things. So there's always some new product that gets sold.
Yeah,
and
I have
the
what I
best
call
way
the
to earn money is there's no free lunch. It's, you have to earn it the hard way, and take some risk, but stay invested for the long term, as Warren Buffett says, buy and hold.
Yes, Paul, what were you going to say?
Sorry to interrupt you there, Mike. I
No,
was
no
gonna say, I
worries,
have
no
what I
worries.
call the barista barometer. And if I'm getting investment advice from a barista, from my clerk at the local grocery store, they could be extremely smart and talented individuals. That might be a sign that a bubble's forming at that point, though. When everybody and their mom's thinking and talking about it, that's probably when it's too late to invest.
Yeah, people think that, hey, my CEO of my company recommended the following, and and I go, well, what? Just because you're a CEO and manage a business does not mean the consumer markets. I find that lots of smart individuals think that the investment world is something that everybody should just commonly know.
Yeah, and CEOs don't even know their own company stock sometimes. So,
Yeah, very smart people, doctors, teachers. We don't talk about money a lot, but we do talk about bubbles. We got to buy into the real estate in 2008. Real estate is always going to go up. Talk a little bit about CNBC.
The talking heads,
For entertainment purposes only.
Yeah. What sells is fear. And unfortunately, they're selling fear most of the time, because that's what gets viewers' eyes, and ratings.
Well, my favorite is like the talking heads, like Jim Cramer, right? He's been around for decades.
Yeah,
failed hedge fund manager. He was a professional money manager. His company went under because of decisions that he made on his investments.
Yeah.
In fact, his hit rate is so low on positive stock recommendations. There's actually an ETF that's being created called the inverse Kramer. Whatever he says to do, that ETF is going to do the exact opposite.
Yeah. So
these guys are talking heads. They're highly entertaining. I like watching Kramer. He's very entertaining.
Yeah.
but not someone I'm going to take investment advice from.
So where do we learn about investments? How do we, because people don't talk about their money. People don't talk about their mistakes. You can't watch TV because you're watching a celebrity. Where do people go?
Luckily today, more than ever, especially with social media has been a blessing and a curse, because you have more access to quality advice than you've ever had before with social media. I mean, we're constantly putting out webinars and creating blogs and all sorts of social media stuff that's totally free and very helpful. But on the same side, you have a lot of people pushing Bitcoin and pushing these manias and trying to get rich off of it. So to find a quality place to start, if you're looking for like the basics, you start with something like what you've got. What you're doing here, Pete, is wonderful and it's very rarely seen. But you've got to start with an independent, trusted third party that's completely neutral, that's going to be giving you advice. If someone is going to sell you something or sell you a service, you got to be careful.
Yeah, but somebody asked me the other day, they asked, is Kiplinger a good place to learn about money? And I go, well, yeah, kind of. It's probably a little better than most. And they asked me for a source. I mentioned NAPFA, the National Association of Fee-Only Advisors. Individuals, can people get on a newsletter, for example, that you guys have? Feasible?
Yeah, you can sign up for the newsletter. On our website, we have something called BFSG University, where we do free webinars. We're actually starting the next series October 26th. And so we do live ones, and then all the replays are there, and it's all free. On the next series has tax planning, budgeting, and student loans.
How do people differentiate you from a Kramer?
Because we're not selling anything, and we're not trying to get ratings or anything like that. It's for most of what we're doing is for our clients, and then we publish it for free, and so anyone else can get that stuff too without needing to sign up for a newsletter or sign up and be on some mailing list if they don't want to be or something like that.
Why don't
Again, it starts here. If you find resources, see if they're a fiduciary and a registered investment advisor. Probably not a broker, because they're probably trying to sell you something, may not be as good advice.
And those websites like Kiplinger and Morningstar and Barron's and stuff like that, there's good stuff in there. And not everything they put out is good. But there's some good articles that we circulate here when we see something like, oh, this is a good read. But yeah, start there.
Okay, Paul, go through this slide.
Again, you just had asked about some resources. These are just some links to other sources that we've created if you want to learn more about specific topics.
Okay. Why don't we stop sharing? Don, come online and talk a little bit more about avoiding the Susie Ormans and the Kramers. Don, how did you learn about the financial world?
Dumb, stupid luck.
You what?
Dumb, stupid luck.
Well, you're a CPA.
That doesn't mean I'm good at investing, and that's not what CPAs do.
No,
and it really is just. I mean, it's a matter of, as we have said here, looking and listening and talking to people. Ironically, and Pete laughs at me. Normally at lunch, I watch CNBC, and I watch what's going on, and I think, wow, interesting. Click, and don't do anything about it. But it's sort of like watching Kramer. You're watching, entertainment, and that's what you're doing. So that's where it's important in terms of what's going on and looking at the various pieces and whatnot. There's a question in terms of the contact information. I don't know if you want to share your screen again and show that the last page you have, or excuse me, next to your last page is disclaimers.
Go ahead and do that, Mike or Paul. Just so if somebody has a follow-up question or wants a free review of their portfolio, That's
And also it's important that all of these, the handout, the material you just saw and the Ask First forms are all on the website and available to you. So if you missed something in here, you can look at that. And there's contact information there also. So.
Yeah, what we tried to do in this particular session is to talk about the real investment world today. And one other thing I've
now we can stop sharing. I think we had
online.
Yeah.
And
there you go.
what I'm seeing a lot of as well is their especially with attorneys and brokers, they use their religion. I've seen it in the Catholic Church. I've seen it in Christians. I've seen in Kingdom Advisors. They belong to the same church, and they say, use me as your professional advisor. Any thoughts on that? I certainly have some, but do you see that affiliated sales kind of
As humans, we naturally gravitate to those that have similar beliefs and those that are like us. That's a natural phenomenon among us humans. So it is natural to want to use someone that's in the same church, in the same religious belief that you have. It's a good starting point, and might help make it a little easier if you find this whole process overwhelming. But they have to go through the same scrutiny that all the other advisors need to go through that we've talked about today. Doing the broker check, looking at the background, do they work with similar clients like you? They may be a great person, but they just may not be the right fit for you because what they're doing might be different than what you need.
Yeah, I think
we get it. I mean, money's it's personal, and you want to know and trust and have transparency across the table from you. And our business, it's like 90% of our business is referral based. Of where we get new clients. And so it's important to know that person, their beliefs, and what their philosophy and processes, but you can't use that as a substitute for their knowledge and experience and everything else. And their abilities. Yeah.
Two of the things that I recommend highly, and that's one is the Ask First form. Understand their education, how they're compensated, whether or not they're a fiduciary, etc. And then the second part comes in religion, the rapport, etc. There's also a thing called the ADV form. What is that in your industry? And what does it mean?
Yeah, it's a disclosure brochure that we file with the SEC that tells, it's really about us and our business and how we get paid and everything like that. It's typically 30 to 50 pages. So
I mean, because you have a lot of bad things about you?
No.
A lot of questions we have to answer for the
requires.
I'm kidding.
Everybody talking.
Yes.
But what they do, a new form that the SEC required a few years ago is called the Form CRS, Customer Relationship Summary. It's a 2-page summary of your ADV that is now required to be given along with that. So you get the abridged Cliff Notes version of your ADV in 2 pages. So that is a requirement. Yes, it is. It's actually a requirement to have it on your website too.
It's a requirement to have on. Anybody who's in the financial services industry needs to have that on the website. So if you go to a Merrill Lynch or a JP Morgan or a Wells Fargo Advisors, they would have to have that form on their website.
Yeah, Form ADV, the Form CRS, and their privacy policy.
Okay,
we're at 11:30. So I thank you all for helping in terms of what all was going on. It was adventuresome getting here today, but we got here.
Yes.
So this is financial and estate literacy. It has been It's Your Money, the financial world. Next week, we won't be here. By plan, we won't be here. Today, we almost weren't here, not by plan. But next week is a void week for us. And then we will be back after that. So you should not get an announcement next week that says we're not here, because we're not here. So I thank everybody very much and appreciate it.
Thank you, Michael. Thank you, Don.
Thank you, everyone.
Thank you all.
Nice day.
Bye-bye.
Bye.